Good morning, students, and all the banking aspirants. Today we are going to talk about bond market or bond valuations, whatever you call it. We will discuss about that. Okay, right. So, bond is nothing but is a type of investment in the capital market. It is a type of asset class in the capital market. How we have a equity, that is our it's a type of asset classes. Same way, a debt market or investment in a bond is a type of asset class or is a type of investment which you are making it. Or otherwise, I say it is a borrowing program. What is mean by borrowing program? Basically, a corporate or a government or a bank borrow from the capital market or borrow from public through capital market. Okay. For example, a corporate go and borrow from a bank. It is called term loan or working capital loan. Right? The same corporate wants to borrow from the market or through a capital market from the public. We call it as a bond. Right? Bond is nothing but is a borrowing program. Even Government of India is borrowing from the market through RBA. Okay, or banks are borrowing for short term in nature, right? So these are all called bond market or debt market. Please remember, in a very basic in nature, bond is nothing but is a type of investment in capital market. Okay, let's understand a little more in detail. First of all, why government wants to borrow? Because the government wants to bridge physical deficit. Whatever the shortcoming on the budget, government borrow through RBI from the public. It is called government securities for a long-term investment and Treasury Bill for a short-term investment. Right? I will put it in a little more in a simpler form. The government securities or instrument issued by Government of India through RBI where publics, banks, corporate can invest in government securities for a long-term period. Okay. Government securities are issued by a Government of India for a long-term investment. For a short term, right, it's called Treasury Bill issued by a Government of India where public, banks, corporate can invest in Treasury Bill. Meaning of short term is less than 1 year. That means the repayment period which is available for the particular instrument is less than 1 year. Long term means it is more than 1 year. It may go up to 30 years, right? Coming back to corporate, why corporate has to borrow from the public? Because the corporate always can borrow from the banks, right? By way of term loan, working capital, bill finance, etc. But there are other methodology which is available for the corporate to raise funds through capital market where public, banks and anyone can invest. Why the corporate go to the capital market for borrowing money? Because the flexibility which is available. They can issue secured debentures or unsecured debentures. They can issue floating rate or fixed rate. Here, the interest rate on the bond is fixed by the corporate. If you go to the bank for borrowing, the bank will fix the interest rate. There may be a negotiation, but the flexibility in raising money in terms of a tenor, in terms of an interest rate, in terms of a security backed up by the bond, right? All these things are which is available for corporate. Okay. So for corporate, which has got a good credit rating, can go to the capital market and raise money from the public, right? That is called the bond. Let's come back to, the banks, why they have to borrow, right? Banks always have a flexibility to borrow from the public from a fixed deposit, current account, savings account, or they can go to other banks through a call money market. All these flexibilities are there. Why banks are borrowing from the public through a capital market? Because if there is any short-term requirement, please remember, if there is any short-term requirement, not for long-term, banks can borrow money from the capital market or through capital market, right? By issuing an instrument called certificate of deposit. Okay. So in the bond market, predominantly, government of India is borrowing, corporate is borrowing, banks are borrowing for short term. When government of India borrowing for a long term, it is called government securities. When government of India is borrowing for short term, it is called Treasury Bill. And corporate borrowing for a long term is called debenture. Corporate is borrowing for short term, predominantly for working capital requirement. It is called commercial paper. Banks only borrow for a short term. That is called certificate of deposit. Okay. In India, the bond market is also available for retail investors. If a retail investor wants to invest in any of the debenture or government securities, they can open an account with any of the broker who are dealing with the debt market, can buy and sell this bond, right? Whenever we are talking about a bond market, please remember this bond market or a bonds or a financial instrument, or we call it as a fixed income securities, is traded in the market, right? What is meant by traded in the market? That means it is the price which is fluctuated based on certain factors, right? It is not like a fixed one, right? That its prices are fluctuates on every day. And this bonds also has got default risk. That means the issuer at any point of time can say they are defaulted, you will not get back the money, right? That is called default risk. So the bond has got two risks majorly. One is market risk, another one is default risk, right? These are all the two element which is attached to this bond market for the investors to look at. Okay. Whenever we are evaluating the bond is valuable for investment. There are 3 4 elements we can look at. The number one is yield. Yield is nothing but a return on the bond which is giving it to a investor, right? So in the yield itself, there are two type of yield. One is yield to maturity, another one is a current yield. Okay, this all we will detail it out on the next video. But today we need to understand the yield is a one which is a element which will evaluate what is the total return generated by the bond. Okay, what is the second one? We will also look at duration. Duration means what is the term which is remaining period which is available for the bond, right? In a simple plain vanilla language, duration is nothing but the term which is available for the bond, right? The bond has got a maturity period that is different from the duration. Duration is different and maturity is different, right? So these are all the two definite terms one should understand and clearly differentiate between these two. Okay, so these are all the two component which you must know about the bond market. One is yield. Under yield, you have a current yield. Another one is yield to maturity. The second one is a duration, right? So duration and the yield, which will have the basic connectivity or influences the bond prices. There is a concept called bond theorem. The bond theorem says the bond value is inversely proportional to interest rate movement. When the interest rate goes up, bond value comes down. When the interest rate goes up, bond value comes down. Vice versa. When the interest rate goes down, bond value goes up, right? So this is an inverse relationship. So the bond valuation is depends on two parameters. One is yield, another one is duration. So these are all the things which we can discuss on the next video, right? Thank you so much. I will connect you on the next video about what is in the yield and how the yield is calculated, how the bond valuation has been arrived, right? What is the quantitative methodology to connect between yield and bond value. All these things we'll discuss on the next video, right? I hope this video is useful to understand what is meant by bond and what are all the classification based on the issuer which you will be able to understand that. If any queries, you can put it in the comment box, right? And we request you to subscribe our channel to get a lot of videos about banking, finance, and financial services. Thank you so much.